Welcome to this personal tax roundup for this month. My name's Dean Wootten. This year we're going to look at a case we looked at before, but it's gone to a high level, this decision. And it's Mr. Keith Murphy, and he was effectively the front man, if you like, behind lots of other similar claims. Now, Mr. Murphy and other officers sued the Met for unpaid overtime and other allowances. Now, the officers agreed to pay their legal team a success fee should they win, and they also took out indemnity insurance to cover their costs if they lost. Now, the officers won their case, and they received £4.2 million settlement plus agreed costs. And these costs were paid direct by the Met to the legal teams, and it was accepted on both sides that court-awarded costs are not taxable. The success fee and the insurance premium were not part of those costs, and the officers had to pay those directly out of their share of the compensation. Now, the Met taxed the £4.2 million payment under PAYE. Mr. Murphy and others claimed tax relief for the success fee and insurance premium in his tax return. Now, HMRC denied that the success fee and the insurance premium were deductible. They argued that the full settlement was employment income and subject to income tax. Now, the first tier and upper tribunal reached contrasting decisions, and this ended up in the Court of Appeal. And the Court of Appeal found in favour of HMRC. The £4.2 million sum was a reward for services, and it was taxable in full under PAYE. The costs separately incurred by the officers could only be deducted from that if they were wholly, exclusively, unnecessarily incurred, which they believed they were not. So those extra costs, the success fee and the insurance premium, as they were not wholly, exclusively, unnecessarily incurred, they were not deductible from the £4.2 million. So sticking to a similar theme, looking at employment income, costs, etc. Now, Eon UK plc, they operate a number of pension schemes, and that included 2 defined benefit schemes. Now, Eon made facilitation payments to compensate for employment package changes. They introduced a 2-year pay deal, the need for defined benefit members to increase future pension contributions to retain the same level of benefits. They also, in part of all that, a commitment by Eon not to make any further changes to their pension for 5 years. Now, the company did not deduct PAYE or national insurance from that facilitation payment. They regarded the payments as compensation rather than earnings. HMRC disagreed, and they raised assessments accordingly. Now, Eon went up to the first tier on this. The first tier believed that the pension facilitation payment could not be separated from the rest of the negotiated package, and this was designed to change future employment conditions. As a result, the payment represented an inducement to provide future employment services, and as such, the members were liable to PAYE and national insurance. The company, Eon, appealed to the upper tribunal. Now, the upper tribunal believed the first tier had erred in law. The settlement payment was part of a package that changed future employment conditions, but the payment was compensation for changes made to future pension rights, and it put the individuals in the same position as before the change. As a result of that, the upper tribunal thought that the payments were not derived from employment, and as such they were not taxable as employment income. We now look at an EIS claim, and this is a qualifying EIS company, or tried to be a qualifying EIS company, and it was Valerian Bloodstock Limited, and they sought to raise horses as well as buy and sell bloodstock. In 2019, the company bought 6 horses for £192,400 and planned to sell them when they were 2 or 3 years old. The proceeds will then be reinvested in new bloodstock, and the remaining funds will be used for the horses' upkeep. No further horses could be bought until one was sold. Now, in March and June 19, shares were allotted to 4 EIS investors. In November 19, the company provided HMRC with 4 EIS1 compliance statements, but unfortunately no advance assurance from HMRC confirming EIS relief had been sought. Now, HMRC requested additional information, and when they got that additional information, it confirmed to them that there was no indication to grow the number of employees or turnover. There was no financial forecast or a business plan to demonstrate growth and development of the business. Everything was outsourced, done by third parties, so the company itself was not acquiring expertise. And the company is not managed by entrepreneurs. It was just individuals participating in a tax advantage scheme. As a result of their findings, HMRC refused to issue the required EIS certificates, stating that the risk to capital condition had not been met. That risk to capital condition, the company must use the money for growth and development, and the investment should be a risk to the investor's capital. So you can see why HMRC reached that conclusion. In addition to that, nor did the company meet the qualifying trading requirement. Its activities were more of dealing in goods of a kind held as an investment. Now, the first year decided it was necessary to look at the circumstances at the time the shares were issued, together with other supporting evidence available at that time. Now, unfortunately, the company failed to provide financial forecasts, there's no business plan, etc., nothing to demonstrate growth plans. There was nothing to suggest this would be anything other than a 3-year investment. So the tribunal concluded that this was an investment opportunity in a tax-efficient wrapper. The horses were held for capital appreciation rather than trading stock, which is obviously what EIS is aimed at, trading companies. And as a result, the appeal was dismissed. We're now going to move on to the implications of a payment under a consent order. Now, on his mother's death, Jonathan James Slade, JJS, inherited farmland. Farmhouse, garden and grounds were left on trust for other family members. The farmhouse was sold and the rest was split into the northern parcel and the southern parcel. Now, JJS was later advised that both land parcels were part of the farmland that he had been left and were therefore his outright legacy or inheritance. He therefore transferred the land, that's the northern parcel and the southern parcel, into his name, together with his son, as tenants in common. They then sold the southern parcel with planning permission for $250,000. Now, other family members, believing that the parcels were part of the residue estate, they commenced proceedings, claims in the High Court, stating they were entitled to their share of the proceeds of the sale of southern parcel. The High Court claim was settled shortly before the hearing, and a consent order resulted in costs and payments of £275,000 being made to other family members. Now, JGS and JMS, the tenants in common, they claimed deductions for those costs and payments in arriving at the chargeable gain they made on the sale of that plot of land, the southern parcel. Now, HMRC denied the deductions, claiming they did not fall under Section 38(1)(b) of TCGA 1992. The sums are not wholly and exclusively incurred to establish, preserve or defend title to or right over the asset. That's when you get your deductions, 38(1)(b). They argued, HMRC, that the sums were incurred in preserving or defending entitlement to the proceeds, not the actual land itself. Alternatively, the expenditure was partly incurred in preserving or defending entitlement to the proceeds of sale and partly in defending title to land, again breaching 38(1)(b). Now, the first year found the payments were incurred in respect of both the southern and northern parcels of land, and that's not going to help the taxpayers very much at all, because they're trying to argue it's in respect of the southern parcel, whereas actually the costs or the payments were in respect of both. So therefore the costs or the payments were not wholly and exclusively on the one southern parcel. They could not be said to fall within Section 38(1)(b), and as a result were not deductible. The High Court claim was a claim over the proceeds of sale of the southern parcel. The consent order payments were damages rather than deductible costs under Section 38(1)(b). Consequently, the appeal was dismissed. That 38(1)(b) is quite tight, and if you're not within 38(1)(b), and wholly exclusively is one of the conditions of 38(1)(b), then you're not going to get deduction for it. And unfortunately, this consent order, this payment, £275,000 related to northern parcel and southern parcel, so therefore how could it be wholly exclusively against the southern parcel? It just couldn't. The tribunal went on to say that the right to take court action for compensation of damages is an asset for CGT. So this is more looking at it from the other side, the other family members that receive this compensation payment. Now, if compensation is received, there is a disposal of an asset for CGT with no acquisition cost. Under Extra Concessions D33, the gain may be treated as if compensation was a part disposal of the underlying asset. Where there is no underlying asset, any gain or disposal of the cause of action may be exempt up to a limit of £500,000. And the tribunal went on to say, it is not clear to us that the other family members will be liable to CGT on receipt of the damages provided for in the consent order. In particular, they were seeking to enforce their rights as beneficiaries under Dora's residuary will trust. They were not seeking to obtain title to the land themselves. As such, it is not clear that there was any underlying asset. It may be that the disposal of right of action would not be taxed as a matter of concession. In any event, the tax treatment of damages in the hands of the other family members is irrelevant to the tax treatment of the appellant's disposal of the southern parcel. Now, this was very much commenting on the recipients of the payment. And what they're saying is, look, they might be taxable on them, they might not. But that has no bearing on whether it's deductible for the taxpayers in this particular case. So it's almost saying that just because we're saying it's not deductible, then it doesn't really change the other side situation. So they're looking at this side and saying, well, actually, it's not Section 38(1)(b), so you're not getting the deduction, but that has no bearing on the recipients of it. That's another matter. Well, let's now look at whether apartment hotels, serviced accommodation, qualifies for IHT business property relief. Now, the L. Batley 1984 settlement held 1/3 of the shares in the Lawrence Hotel Living Limited Company. Now, the Lawrence Hotel Living Limited Company owned 4 properties in York and Harrogate, and they were serviced apartments. So effectively, apartments that were serviced. You might stay there for 1 or 2 days, and it would have been pretty much like a hotel in many respects. There would be tea, coffee, milk, etc., Wi-Fi, bedding and towels be changed. It's in between, really, in between rental property and a hotel. Now, a 10-year anniversary charge was due on the 14th of November 2014, and the trustees claimed 100% business property relief. HMRC denied that on the basis that the business was simply holding investments. The trustees appealed. Now, it was held that although it was a business, the guests rarely spoke to staff, and you don't. When you stay at these places, you literally probably get a code for the door, and you don't really see many people, if anybody. Food and extras accounted for less than 5% of turnover, which would be very much unlike a hotel. And the reception was an administration centre rather than the proper hotel reception. So the business was not a hotel business, but rather just serviced apartments. And it's that fine line. If you are a hotel or like a hotel, then you're going to get the business property relief. But they didn't do enough. They didn't get close enough to the hotel status. Now, some apartment hotels could be categorised as providing services together with accommodation. So some serviced offices will be like hotels, but this wasn't the case here. The company's principal activity was investments, pretty much like buy-to-lets, if you like. So no business property relief was available, and the appeal was dismissed. Now we'll look at an SDLT case, or I should say landed property tax, but landed property tax in Scotland, same essential thing as SDLT in England. So Mr. Ian Robertson versus Revenue Scotland. Now in February 20, Ian Robertson bought a house that needed renovating before he was able to live in it. And he paid £4,000 additional dwelling supplement because he owned a flat that he'd have been able to sell during the COVID lockdown. So when you buy a property, if you've got more than one, then normally the additional dwelling supplement is payable unless you can prove that you are replacing a main residence. Now, his family had promised to help him renovate the property, but post-lockdown, this help was not forthcoming for various reasons. Now, he did some work himself before spending 3 weeks in bed with mobility issues. And unfortunately, he was unable to complete the renovation, and he sold the property in April 2021 without ever having moved in. And the lawyer submitted an additional dwelling supplement repayment claim for £4,000. HMRC denied the repayment. As far as they were concerned, the conditions for additional dwelling repayments were not met. Now, those conditions are, if you let's say I've got a property like this chap had, and if he sold it and bought another dwelling, then obviously he wouldn't have paid the dwelling supplement. But unfortunately, he couldn't sell his old dwelling before he bought the new dwelling. So therefore, he would have paid the additional dwelling supplement, the additional 3%, SDLT or LBTT in this case. So that's the predicament. So normally you pay it because you haven't managed to sell your old one at the time of purchase. But if you then sell the old one within 3 years, then you can get a repayment of the additional dwelling supplement. So that's the rule. Now, unfortunately, he didn't sell the one that he was leaving, but he tried to say, well, actually, isn't it kind of the same thing, same spirit, if you like. So he appealed, arguing that he'd been caught by a set of rules that were not meant for his situation. Now, the tribunal acknowledged that this was a very sad case. He couldn't occupy the new house due to factors outside of his control. Now, it's the Scottish Parliament's intention that additional dwelling supplement should only be repayable in the limited circumstances set out in Para 8.1 of Schedule 2A of the Land and Buildings Act, i.e. selling the old dwelling within 3 years. Now, the buyer must dispose of the dwelling, but not the one that was the subject matter of the charge or transaction. As I say, he should have disposed of the old. Obviously, he had no choice. But the repayment is there when you sell the old dwelling within 3 years of buying the new one. As unfortunately, the disposal of the new house could not trigger the repayment of the supplement. The supplement was properly charged. Now, Revenue Scotland could only apply the legislation as drafted. It could not change that. They had no discretion to change the law. And that's going to be quite typical of all courts. If the law says one thing and all HMRC are doing is applying the law, then you rarely get any court overturning that. They haven't got that discretion. So unfortunately, in this case, the appeal was dismissed. Well, that concludes the personal tax roundup for this month. My name's Dean Wootten. Thank you for listening.